The biggest problem we've had in our economy over the last 2 years has been labor shortages. Labor markets have been incredibly tight, with unemployment at a record low 50-year level. For the last 2 years, there have been more job openings than people looking for work. In other words, there are a lot of space out there to absorb people on the other side of this thing. It doesn't seem like a lot of people are necessarily going to be out of work for long. This has been a very, very clean credit market, certainly not one that's going to implode simply on the basis of a 2 or 3 month shock. This panic seems to be more about getting headlines than actually, if you will, having a realistic conversation about where things are. So we're talking about a federal government that's rapidly approaching a major fiscal crisis, one that's going to happen within a decade, and it seems to be inclined to bring it closer to us. You know, if we had some fiscal responsibility at the federal level, this would have been a much better way of dealing with the situation. Sadly, we didn't. And of course, we are generating even more long-run problems. It's good they're doing the things they're doing right now, but remember, all this money will have to be paid back at some point in time. Growth this year, which should have been about 2%, will be 0%. So we've still lost. There's no doubt about it. There's still a hit. But this is very, very mild. And in fact, some folks might even question whether or not it's technically a recession. You know, you need a longer period of negativity to call it a recession. I'm not sure this qualifies, but that's an academic debate. No doubt Q2 is going to be one of the ugliest things ever, but we're looking for a rapid bounce back. Obviously, some moderate uptick in debt distress, stock market, who knows? But of course, overall, little impact on venture capital. And the U.S. economy started this in one of the fundamentally most sound positions it's been in 30 years. It's not a fragile economy. We can take a hit. And if the government's doing what it needs to do and we work with each other, we should be able to bounce back really quite rapidly. There's no doubt about it.
Hi, everybody. This is Dr. Christopher Thornberg with Beacon Economics, and I'm thrilled to be back with Group 11 to discuss our economic outlook for 2023, with, of course, a special focus on technology and the venture capital industry. Now, it's interesting because the last time I had an opportunity to work with Group 11 was back in 2020. Now, back then, well, the economy was in the midst of an existential crisis, you might say. Of course, the pandemic had showed up on our shores, and because of public health worries, we saw a variety of closures across the economy. And some of the headlines coming out of that particular episode were truly scary. Well, in a very real sense, here we are yet again. Now, of course, the pandemic is largely behind us, but if you look in the newspaper, you see all sorts of negative headlines discussing yet another recession, whether it's Jamie Dimon talking about economic hurricanes or Mark Zandi calling yet another downturn in the housing market. Lots of negativity out there. The Wall Street Journal Next Recession Survey suggests 2/3 of economists think we're going to have a recession this particular year. Now, it's interesting because, you know, this trend of pessimistic headlines is nothing new. Over the last decade, I have seen this happen over and over and over again. Something I've called miserableism. That is to say, the philosophy of pessimism where no matter how good the data is, you have to tell us how terrible everything is, how tragic everything is. What's interesting about miserableism is it turns out I'm not the only person thinking about this disconnect between the stories we tell ourselves and the actual economic realities, at least according to the data. Not too long ago, Robert Shiller, Nobel Prize-winning economist, wrote a wonderful book called Narrative Economics. And in it, he makes the point that economists ignore the narrative at their own peril. Look, in the Chicago School of the World, you have information, you have data. As rational agents, we take all this information in and we make the best choices possible. It doesn't always turn out right, but we do the best we can. But what Schiller points out quite clearly is, well, people don't respond to information and data quite that clearly. In fact, he goes on and he points out that while data and economic analysis in its modern sense has been around 100, maybe 150 years, narratives have been with humanity since the dawn of civilization. And he goes on to point out that this gap between the narrative and the reality is nothing new. In fact, if you look over the course of history, you will find plenty of periods of time where the narrative and the reality have diverged quite substantially. And the way to think about this idea is very simple. If the narrative and the reality are close together, we know that policymakers are pursuing the right objectives. We have a good sense that businesses are going to be pursuing good, shall we say, investments. But when the narrative and the reality start to diverge from each other, well, therein interesting things start to happen. Or, as Robert Shiller points out, business cycles start to be created. Now, this is nothing new. Think about it. Back in the late 90s, we heard a narrative. That is to say, you could take any company, slap a .com behind it, and add $1 billion to its valuation. Turned out that wasn't quite right. And we all heard back in 2006 that you could take a bunch of subprime debt, slap it together, and sell off tranches of it as AAA gold-plated securities. Yet again, a broken narrative. In both of these cases, eventually economic realities started to come to the surface, and of course, therein began a business cycle. So paying attention to the narrative becomes almost as important as paying attention to the underlying data if you want to be a good economic forecaster. And so that's what we're going to talk a little bit about today, the narrative versus the reality. Now, I understand that we had some mixed economic signals in 2022. After all, in the first half of the year, we had very limited growth. We only got a positive number in the third quarter, and overall growth, at least as of now, we haven't gotten the fourth quarter numbers yet, basically 0% in 2022. We also saw a collapse in the University of Michigan Consumer Sentiment Survey to levels we haven't seen since the middle of the Great Recession. Although between you and me, this doesn't feel like the Great Recession. And of course, if you're a big financial data wonk, you probably already know that the yield curve has indeed become negative. By the way, the yield curve is nothing more complicated than the difference between long-run and short-run interest rates. Typically, long-run interest rates are higher than short-run interest rates. But every once in a while, something weird is happening inside the economy and they flip. That's what we call an inverted yield curve. Why is this important? Well, most recessions are indeed led by an inverted yield curve. So if you believe in numerology, this should tell you that, oh boy, we're going to have a recession this particular year. Now, between you and me, this is correlation, not causation. And I, for one, just put this to one side. I don't think this is of any importance whatsoever. And we'll come back to that in just a second. More important has to do with where we are as the economy right now. When you think about a recession, remember, it's a period of time where the economy is not living up to its potential. It's not producing as much in the way of goods and services as it could or should. And we see that largely by, of course, the fact that factors of production are simply not being utilized. The unemployment rate is a classic case of this. A lot of people who want jobs but can't find them, that's a good sign of a recession. Or a very low capacity utilization, a period of time where manufacturing companies could produce more, but they can't find buyers for those particular products. Well, right now in the U.S., capacity utilization is quite high. Industrial production is at an all-time high level. And over the last year, the unemployment rate remains stuck firmly below 4%. That's what we call a full labor market. And with all that in mind, clearly we are not in the midst of a recession. And we are about to get those fourth quarter numbers. And when they do come out, we anticipate that we're going to see somewhere between a 2 and 3% growth rate. So no matter how you look at it, we're coming into 2023 with an economy that seems to be running at full capacity, and we're going to have good economic growth coming into this particular year. So what is going to happen this particular year? Well, to be clear, the narrative, all those scare stories you see in the newspapers are pretty obvious what they're saying, right? First of all, you have to start with the basic idea that the economy is already in a crisis. Now, why is it in a crisis? Well, pick your favorite boogeyman. It's inequality, it's global warming, it's tax rates, regulations, whatever the case may be. For some reason, many people are absolutely certain that the economy is currently in a crisis. But then on top of that, you have to add in two big things that happened over the course of 2022. First, of course, is the big onset of inflation, which, as we hear, is crushing consumers. And of course, we're in the midst of yet another real estate collapse driven by the sharp increase, particularly in mortgage rates. So this is the story. What's the reality? Well, as I see it, having a recession in the next couple of years is extremely unlikely for any number of reasons. The first thing, of course, has to do with consumers. Consumers are not being crushed by inflation. Quite the opposite. Consumers are driving inflation because they're flush with new wealth. That means over the course of this particular year, consumers' spending should remain strong. And since they are the 800-pound gorilla in the U.S. economy, representing over 70% of GDP, if the consumer is healthy, most everything else is a sideshow. More importantly, if I look at the economy as a whole right now, I don't see any major structural imbalances. I don't see any reason for some part of the economy to suddenly contract dramatically, creating the conditions that typically lead to a recession. And while I appreciate inflation and rising rates certainly have been a big news story over the last year, we have to remember these are consequences of policy choices made a couple years ago. These are not, shall we say, purely exogenous drivers that just hit the economy and cause recessions out of the blue. Indeed, inflation and rising interest rates have never caused a recession in the United States, and to simply think they will right now just doesn't make a lot of sense. What do we expect in 2023? Well, as already noted, consumers and business investment will continue to offset some of that weakness in real estate, finance, and other interest rate sensitive sectors. As for asset prices, they will almost assuredly continue to deflate from that pandemic stimulus high they hit a year ago. This is just to be expected. But what's more important about assets is that the fundamentals are going to remain strong. Sure, stock market prices are coming down, but you look at corporate profits, they still look very, very good. Now, am I just a complete bull and I think everything's fine? Of course not. Look, there are some problems in our economy today. For example, the big hike in mortgage rates is collapsing the filtering process in our housing markets, and that's going to intensify housing shortages. Labor shortages are here and here to stay, and that, of course, is something that this nation needs to start dealing with. We have public deficit challenges, but the biggest problem our nation faces is the ongoing gap between the narrative and reality, which continues to push policy, to push, if you will, our opinion about where our economy is going in completely wrong directions. So let's start at the beginning. How did this all happen? The U versus V debate that happened a couple of years ago. And these are some of the headlines I was discussing back then when I talked with Group 11. 30 to 40 million people are going to be evicted by the end of 2020. Mark Zandi told us 15 million households are going to stop paying their mortgage, and prices are going to fall any second now. The coronavirus is going to scar the U.S. labor market for a decade. And of course, the UCLA forecast that told us that, make no mistake, this has turned into a depression-like crisis. Well, as I told you last time, it wasn't going to be a depression-like crisis. Indeed, this was one of the deepest recessions the nation ever saw, but it was also the shortest. You know, we saw a huge decline in economic activity in the second quarter of 2020, and by the third quarter, we were out of it. The economy was zooming back. There was no massive problem in our economy. Why the V, by the way? Well, you know, it was a different kind of recession. Most recessions are driven by some large drop in aggregate demand. A Great Recession is a classic case of that. Asset prices have been pushed up by all that crazy debt pushing into the market, and when the debt bubble broke and asset prices came down, suddenly people realized they weren't nearly as rich as they thought, but they still had all that debt. Suddenly, people had to rebuild their life savings, and that meant aggregate demand was down and stayed down for a long time. Well, that never happened this time. We had an economy that was really quite healthy when this thing hit, and this was a completely different kind of recession in as much as it was a true supply shock recession. What happened here was very simple. A portion of the economy was closed because of the pandemic, but that didn't cancel the spending, it just shifted it. Either it shifted it from the services that were closed to goods. Remember in 2020 trying to buy a bicycle, a car, a hot tub, everything that wasn't nailed down in the store that was gone? Or, more importantly, people simply saved that money and they were going to spend it in the future. So it was spending that was shifted, not canceled, thus the economy was going to come roaring back. But don't let good economic analysis get in the way of an even better narrative. Congress didn't listen to that, and they went crazy. They lobbed $6.5 trillion at the economy in the form of fiscal stimulus, that is to say, deficit spending, in 2 years. Now, mind you, let's put that in context. Because of the pandemic, the U.S. economy lost about $1 trillion in economic output. So for every dollar in lost output, Congress saw fit to give the U.S. economy $6.50 in stimulus. That was a crazy over response. And what makes it even more interesting was when you start to ask the question, how? How do you actually come up with the extra couple trillion in borrowing a year? Prior to the pandemic, the fiscal deficit was about $1 trillion. Where do you suddenly get a couple $1 trillion per year to make up that balance? Well, very simple. You call the Federal Reserve. Jerome Powell helped out by, of course, engaging in $5 trillion of quantitative easing. That is when the Federal Reserve goes out and buys government debt with newly printed money. The way to think about it is in 2 years, Congress ran $6.5 trillion stimulus program, and $5 trillion of that was funded by nothing more than printing money. Now, you might say, so what? I mean, Ben Bernanke did it. He did $3.5 trillion in quantitative easing over about 6 years, and he just won the Nobel Prize. How bad can it be? But you got to remember that Ben Bernanke and Jerome Powell were facing completely different circumstances. You know, when Ben Bernanke was chairman of the Federal Reserve, he happened to, well, either the fortune or misfortune of being there when, of course, this massive subprime debt bubble collapsed. Why is that significant? Well, you want to know what causes a depression? It's not a pandemic, it's deflation. And that was the big problem that Ben Bernanke faced back in his term at the Federal Reserve. I mean, after all, you had a collapsing financial system. You remember the banks that were getting pushed to the edge of bankruptcy. You had, of course, a couple of major investment banks go down. And what happens is when banking system starts to go down, it creates deflationary pressure in the economy. In other words, had Ben Bernanke not worked aggressively to expand the money supply to offset those deflationary effects, the Great Recession could absolutely have turned into a depression. So my question for Mr. Powell is, what financial crisis were you actually dealing with? What war were you fighting? Because back then, we could see it. You could see it in the bankruptcy data, the foreclosure data, all sorts of things. This time, nothing happened. The debt markets were amazingly clean. Banks made good profits through this. There was no financial crisis. Ergo, this time, when you threw $5 trillion at the economy, it just went straight to money supply expansion. And take a look at this graph. On the top line here is M2 growth, 3-year M2 growth, really going back to the 1970s. And this is very straightforward. 1970s, we had too much money supply growth. We had inflation. For a long time, the Federal Reserve had it down pat, doing a good job keeping money supply stable, hence price growth stable. You get into where Bernanke's there, you can see $3.5 trillion in quantitative easing over that 6-year period, and money supply growth, a little jagged, but stayed within that good 20% 3-year range. And then Powell comes into play, $5 trillion, a 50% increase in money supply. And I mean, really, the question is why are we surprised we have inflation? Indeed, you know, one of the things about this entire conversation is not why we're having inflation, but how surprised we are about the fact that we see that we're having inflation, given the policies the Federal Reserve has pursued. And, you know, I like to point out that this is not rocket science. Another economist who won the Nobel Prize, of course, is Milton Friedman. And he wrote a book, well, he wrote hundreds of articles and books on this particular topic. But one I like very much is Money Mischief. He wrote it in 1982, and it was really kind of a fun conversation about episodes in monetary history, really made, if you will, for a more layman kind of audience. And in the first chapter of this particular book, he lays out exactly what happens when you put too much money at the economy. The first thing that happens is money illusion kicks in. All this cash is floating around the economy. People feel rich, businesses feel rich, and you see interest rates drop, asset prices take off, and spending and investment both start to increase dramatically. It feels good, kind of like it feels good after you drink a half a bottle of tequila, because all of this is nothing but an illusion. In the long run, real wealth is the ability for an economy to produce goods and services, and that is limited by our technology, by our labor, by our human capital, by the systems that tie all this together, our market efficiency, if you will. Eventually, when you have demand pushed beyond the capacity for an economy to truly produce goods and services, well, the only thing that can re-equilibrate this problem is inflation. By definition, inflation has to start to kick in, and that's when everything starts to wear off. Asset prices start to come down again, interest rates start to go up again, and of course, consumers and businesses have to pull back from those levels of spending they were at. This is the hangover, and that is exactly what our economy has been suffering over the course of 2022. We're not entering into a new business cycle, we're suffering the hangover of the excessive stimulus that were put into place. Now, here's a good way of looking at it. On the left-hand side is growth in household net worth. And this is not the first time we've seen this kind of asset cycle. We saw a big asset cycle, of course, in the late 90s. We saw it in the run-up to the Great Recession. And here, of course, we're seeing yet another run-up on household net worth driven by Jerome's quantitative easing. Three major surges. Let me put this in context. About $30 trillion in new household net worth was generated by the excessive amount of stimulus and money printing, and that in turn, of course, has led to a surge in consumer demand and, yes, inflation. We saw inflation really start to pick up in 2022. The CPI hit about 9%, the PCE about 7%. But again, what's the surprise? For me, the big surprise here, of course, is the conversation. Because when you hear bright economists like Janet Yellen get up and start discussing inflation from a policy standpoint, what do you hear? Well, you hear them breaking down. Well, it's because of supply chain issues. It's the federal deficit. It's greedy corporations or not enough manufacturing jobs. Biden's bad green energy policies. Now everybody can agree it's Putin's fault. But really? I mean, we know better than this. Right? And next thing they're going to be telling us that Saturn isn't aligned with Jupiter. Kim shouldn't have dumped Kanye. Perhaps it's the Lakers' horrible perimeter defense. Stop all this. As Milton Friedman said, inflation is everywhere a monetary phenomenon. It is and can only be produced by a more rapid increase in the quantity of money than output. This is not complicated unless, of course, you live in a miserablest time. Remember, in Washington, D.C., they are convinced that 75% of households are living hand to mouth and are one paycheck from being homeless. In that world, you can't say out loud the truth. The truth is we have inflation because consumers are spending too much money. Not allowed, ergo, you have to come up with all these silly excuses. And the best place to see this, of course, has to do with gasoline prices. You know, gasoline prices went up 50% over the course of 2022. And you saw all sorts of news articles about how tragic and terrible this was for Americans. But take a step back and think about what actually happened last year. There's little doubt prices went up a lot. In 2021, gas prices in the U.S. were running, $3.40 a gallon. In 6 months, they hit $5 a gallon. They increased by 50%. But if you thought that this was nothing but a supply effect, well, when the supply goes back, prices go up, and consumers should consume less. What's amazing is, despite that enormous increase in gasoline prices, vehicle miles driven barely budged. And of course, because of the shortage of cars, car prices were still incredibly high over the course of that particular year. Clearly, this was not a supply effect, it was a demand effect. It was driven by the fact that consumers, despite the fact that oil was in slight short supply, they didn't care. They wanted to do their trips, they wanted to go to work, they wanted to go out shopping, and they were going to. It just didn't matter. It's simple as that. And that's why, of course, they keep getting these inflation forecasts wrong. I mean, think about it. If you think that this is nothing but a cost-push inflation spurt, then yeah, when oil prices come down, so too should inflation. But if you recognize it's demand, well, when gasoline prices go down, that just gives people more money to spend somewhere else, and prices there start to go up. Ultimately, the big question is how much farther will inflation actually go? Well, I like to go back to the good old-fashioned monetary version of things. And in this world, only thing you have to do is look at the supply of money relative to the size of the economy. Well, if you take a look at this, what we call the unit money supply, it suggests we have about 15% more inflation to go before we get the amount of money in our economy re-equilibrated with the price levels. Now, will it be exactly 15%? No, because it depends on what the Federal Reserve is going to do. How aggressive will they be about quantitative tightening? It also depends on how much real growth we get in the economy, and will there be a change in velocity? But it's still clear that inflation is going to be running hotter than what the markets seem to be suggesting right now. Now, one of the interesting things that also happened has to do with how the Federal Reserve has responded to inflation. You know, they created inflation by printing $5 trillion and handing it to Congress to fire hose across the economy. They're not fighting inflation by taking that money back. Quite the opposite. They're fighting inflation by raising the federal funds rate. So they gave with the printing press, and they're taking back, if you will, with those interbank interest rates. And that means, of course, that interest rates are being driven up relatively sharply, but they're not really taking cash out of the system. And there's little doubt of the interest rate response. Take, for example, mortgage rates that started below 3%, got close to 7%, towards dropping back to about 6.5%. That's a big hike in interest rates in a fairly short period of time. And of course, yeah, it's creating some problems in our economy. For example, we've learned that gravity still works. Take NASDAQ, for example, which has fallen pretty sharply, almost 30-40% from the peak it was at, although worth noting, still above where it was just 3 short years ago by a good margin. Or home prices, which seem to be dropping. According to Case-Shiller, prices are down about 5.5% right now. But to be clear, over the preceding 2 years, they'd risen by 42%. So while asset prices are coming down, they're still up well above where they were prior to the pandemic, prior to this crazy surge in stimulus. And even, of course, Bitcoin, which is, I don't know, trending at $15,000 or whatever it happens to be right now. I mean, look, that's down from the insane 60,000 it's at. But as I like to point out, you only need about $15,000 or $16,000 more decline for it to get back to its fundamental value of zero. It's unbelievable to me that this is even a thing in this particular world. Anybody who's a big crypto buff, 5 letters, Ponzi, Italian guy, lived 100 years ago, look him up, you'll see what I'm talking about. Yet again, just insanity. Now, putting that to one side, where's the real economy? Where are we going here? Well, it wasn't a clear sort of imploding economy in 2022. More of a mixed bag. Consumer spending, for example, continued to add in 2022, about 1% overall. Overall spending on equipment, intellectual property remained relatively strong. But other parts of the economy, for example, residential investment went way down, investment in non-residential structures went down, spending on durable goods went down. So definitely a bit of a mixed bag across the board at this point in time. Now, what does this tell us? Well, let's think about the consumer. Again, as already noted, the consumer is the 800-pound gorilla in the economy. Where they go will tell us a lot about where the overall economy heads. Well, consumers are doing just fine. Take, for example, the weakness we've seen in non-durables. That's mainly driven by the fact that, folks are going back to services again. They're not buying as much food in the supermarket. They're going out to restaurants right now. Restaurants are busy as we've seen in a very long time. And of course, you want to think about services. One of the most famous services that we can all indulge in is the services provided by the wonderful place known as Las Vegas, which happens to sit in Clark County. Take a look on the right-hand side here. Gaming revenues in Las Vegas have never been higher than they are right now. And that's amazing when you think about it, considering that the convention business isn't fully back and the Chinese whales aren't flying in. So this tells you a little bit about how much consumers aren't really suffering. In fact, they seem to be doing pretty well. And as for spending on durables, let's keep in mind that what's happening in that part of the market is there would be a lot more consumption if it could actually be met. You probably heard that last year was a really bad year for auto sales, no doubt about it. However, most dealers don't seem to be terribly upset about that. Yes, it's true, their sales are down about a third. However, their profit margins are up by 2, a factor of 2. What's happening out there? Well, yet again, this is not a function of a lack of demand, but a lack of supply. The auto industry, almost more than most, has been hit substantially by, of course, simply the problems in our supply chains. A couple of years ago, there were 1.2 million cars for sale at any given point in time in the U.S. economy. Right now, 100,000. That's it. This is a problem not with demand, but simply with supply. So the real question here, of course, if I'm being so optimistic, what is the story coming out of those who are telling us that the economy is about to implode? Well, of course, the story has everything to do with income. After all, you take a look at the right-hand side here, you can see that real disposable income has fallen because of inflationary pressures. It's about back to where it was in 2020. And those who are telling us that the consumer is having a big problem will point to the fact that the savings rate has dropped to about 2%. The last time we saw a savings rate that low was, of course, in the run to the Great Recession. This, they say, all suggests that the consumer is about to take a big step back. But I like to point out that it's not about income, it's about wealth. And Americans still have lots of built up wealth because of the craziness over the last couple of years. Even with the pullback in the stock market, overall household wealth is still up about 13% or 14 trillion from where it was pre-pandemic. That's lots of money. And to be clear, what's really important here is what kind of wealth. Much of the decline, of course, has been in those equity markets where NASDAQ and the S&P have all come down quite a bit. But to be clear, that doesn't have a direct impact on spending like other forms of wealth. Why? Well, a whole bunch of it, of course, is held by the top 1%, and much of the rest of it is sitting in 401ks and other types of retirement accounts. In other words, it's a future thing, not a now thing, and you don't see it have the same impact. What does have an impact? Well, equity and, of course, the good old-fashioned cash on hand. And by the way, that's the other number I want to tell you about. Take a look at this right here. This is cash on hand for American households. This is kind of a choice, if you will, because you want to keep cash on hand for liquidity purposes, for current spending purposes. But if you start getting too much cash on hand, you want to get rid of it. How do you get rid of it? Well, you invest it. You put it in your retirement account. Maybe you buy a durable asset like a car. Well, think about where we are right now. Prior to the pandemic, all American households together were hanging on to about $1 trillion in just cash. This is money in your checking account, your savings account, sitting in a box under your mattress, as the case may be. Keep that in mind, $1 trillion. Well, after a couple of years of the stimulus, right now we are seeing households with $5 trillion in cash on hand. Now, how about the housing market then? Isn't that due for a big collapse? Look, there are some worrisome signs. We know that. For example, existing home sales have absolutely plummeted and are almost back to the levels they were during the point of the Great Recession. And home builders are worried because they're suddenly starting to see that dangerous buildup in new homes for sale. All this should start bringing back some degree of PTSD for all those people in the housing market who are wondering if we're due for a very similar meltdown. So why is the housing market getting so cold so quickly? Well, we know because mortgage rates have risen so much. They were 2.5% a couple of years ago. Now they're 6.5%. And yes, that's going to cool the market off. But this is a completely different circumstance than what happened during the Great Recession. The meltdown in housing that occurred during the Great Recession was driven, of course, by the excessive amount of lending within the market of subprime debt. Subprime debt that really caused the housing market to overexpand in terms of prices, but also caused an oversupply of new housing because builders responded to that by building excessive number of new single-family units for buyers that didn't really exist. You think about where we are today, and it's the complete opposite. Take, for example, the mortgage market itself. It's been a very conservative decade for overall borrowing, and the borrowing that has occurred has really been to very high FICO score type borrowers. Over the last decade, the vast majority of new mortgage debt has gone to these high FICO score borrowers. And because of the overall conservative amount of borrowing going on over the last decade, you have a housing market today that has one of the lowest debt to equity ratios we've ever seen. We have equity levels at a level that we've never even imagined. In the peak of the Great Recession, it was $15 trillion in equity in all 1 to 4 family homes. Today, it's $30 trillion of new equity, lots of cash, clean credit. This is a rock solid market from that particular basis. And of course, as far as supply goes, well, yet again, because of a decade of miserableism, builders have been scared to build too many units. And we come into the pandemic with a very low vacancy rate already built into place. Then when everything took off and everybody started buying things like crazy, vacancy rates became even tighter. What's interesting is we have a very high supply of new homes for sale, but supply of existing homes for sale remains near a record low level. Overall vacant units in our economy, again, in a record low level. The problem in our housing market today is not a function of having not enough buyers the way it was, say, in 2009. Today, the problem is not enough sellers. These are incredibly tight markets, but the basic filtering process that drives our housing market has broken down. What do I mean by filtering? Well, In housing markets, builders, developers typically build at the top end. And then when you build a fancy new single family home, someone moves in there, they empty a home, someone else moves in there, and so on and so forth. So economists say you build at the top to supply at the bottom. Well, how many folks are going to sell their home at a 2.5% mortgage rate to go buy a new home at 6.5%? That's where the problem exists. People are not going to walk away from their mortgage, and the market is freezing. But there's still plenty of demand for housing out there. Only place you have to look is at apartment rents, which continue to rise at a very high pace because, again, tremendous amount of demand, not enough supply. It's not a market that's going to melt down. It's just a market that's going to get very cold. And of course, while we're talking about fundamentals, let's talk about businesses. Because yet again, for all the negative news in the headline, business profits did very well last year. In the third quarter of 2022, corporate profits hit an all-time high level, and numbers are coming in very good for the fourth quarter. Proprietor incomes have also been rising. And for all the conversation about rising interest rates, the reality is non-financial corporate debt-to-equity ratios are very low right now. Companies are not terribly subject to the increase in interest rates. They just seem to be shrugging it off. You certainly, of course, see that in the bond markets, where there's very little bond market distress right now. Financial fundamentals look very good despite all those negative headlines. The big thing they're dealing with, well, over the last decade, we've seen negative real interest rates in the U.S. economy, something that a lot of economists say is not terribly healthy from a long-run perspective. Right now, they're simply adjusting the fact that real interest rates are getting into a positive territory. This is a change we need, not a change that's going to break our economy. And as far as businesses go, if you talk to them today, they won't tell you that, things are falling apart on them. In fact, most businesses say, despite all those negative headlines, their biggest problem is hiring enough people. After all, the job openings rate today remains above 6%. Contrast that to prior to the pandemic, when job openings rate were less than 5%. We still have too many job openings across the U.S. economy, particularly in places like healthcare, leisure, hospitality, professional services, logistics, so on and so forth. What happened? Where are all the people? Where are all the workers? Why aren't they out there picking up these jobs and helping the U.S. economy expand? Well, there's a short run and a long run explanation to that. The long run explanation is basic demographics, and of course, all starts with the boomer generation. Boomers came out of enormous families. 8, 9, 10 kids were common. Apparently, they were also scarred by that particular circumstance. They all went out and had 1.2 kids. Now, that may, make for a nicer home life, if you will, but at the same time, it's also meant that a population pyramid has turned into a population column. And now that boomers are starting to retire, for every boomer that retires, you're only bringing one Gen Z into the labor market. That is simply not enough to expand our labor force sufficiently. And as a result of that, well, labor shortages were already creeping up before the pandemic. Remember that 3.5% unemployment rate we had at the end of 2019? It was not driven by the policies of the previous administration. That was the fundamentals of demographics. But the pandemic took this sort of long-run crisis and turned it into a short-run acute crisis. Why? Because it was a pandemic that convinced a couple million people to go ahead and retire, to leave the workforce completely. And today, of course, those folks are remaining largely on the sideline, and businesses continue to scramble to try and pick up the slack. Now, there are some upsides to this particular circumstance. One of the upsides is one of the big issues of our era, income inequality, is actually starting to reverse itself. Take a look at the left-hand side here. This is growth in worker earnings by quartile, and the dark line there is the earnings growth for people in the bottom quartiles of earnings. Now, mind you, typically they don't do too well in our world, but starting roughly about 2015, you started to see worker earnings for the bottom quartile grow faster than the other three quartiles. And of course, that particularly picked up over the course of the pandemic. Labor shortages that created massive opportunities for workers that are out there, and you see it in those wage rates. Why is this a two-edged sword? Well, while this is great for workers, why it's great for the fact that income inequality is falling right now, on the other hand, it's tough for companies, particularly those companies who use a lot of the lower skilled, lower paid workers. You see a bigger increase, for example, in earnings for non-supervisory workers in construction, logistics, and many other sectors. Both the lack of labor and the cost of it has become a predominant issue for so many companies out there today. And this is a big issue that until we figure out how to fix our immigration system is going to remain within the economy. Which brings me back to businesses, and more importantly, more specifically, business investment. Because, yeah, we know because of the increase in interest rates, you're seeing pullbacks in investment in interest rate sensitive parts of the economy, particularly, of course, real estate, whether it's non residential structures or residential structures. But if you take a look at where business investment is going right now, yeah, they're walking away from power and communication and mining and commercial and healthcare relative structures compared to a few years ago. But look where the numbers are high. Software, information processing equipment, research and development, all of these are up 20, 30% from where they were pre-pandemic. New orders for new defense capital goods is at a record high level right now. What are businesses doing? They're trying to figure out how to do more with less. If you're going to expand your output in an era of labor shortages, capital investments is the way to do it. And again, yet again, this is where you see strength in our economy. You know, labor shortages are leading to, of course, greater and greater investment in systems that allow you to leverage your existing workforce. Now, this, of course, brings me into technology and venture capital. You know, when you think about labor-saving technologies, you have to think about the technology industry, Silicon Valley, and all the information technology that we need, if you will, to help businesses continue to grow even in this era of labor shortages. And a centerpiece of that, of course, is the venture capital industry itself. Now, it used to be that a lot of research and development occurred within the corporate structure, as the case may be. But over the last bunch of years, you have seen this whole new way of developing new technologies, a more market-based approach, where as opposed to developing technologies within companies and then trying to, shall we say, market it outside the company. Take, for example, in the context of like a old way of doing pharmaceuticals, today it's a little different. Now we have a plethora of small companies with good ideas, really in a race to get attention and get money from the venture capitalists. So here you allow, of course, the market to drive new ideas, and the venture capitalists are the ones there to pick those winners and push them forward. Now, this is a great way of helping this economy continue to grow. But the venture capital industry is nevertheless still yet another finance industry. And the craziness, the chaos you saw over the last couple of years in the equity markets, the chaos you saw in the housing markets, was similarly seen in those venture capital markets. From 2020 to 2021, there was a near doubling of venture capital investment by dollar value in the United States. And candidly, that was just not sustainable. Now, things are calming down, and yet it feels bad, kind of like it feels bad that your home price is going down or your stock market portfolio is going down. But remember, what we're doing here is simply suffering the pandemic hangover one more time. It's the same old story. We're simply cooling off to where things had been prior to the craziness. Venture capital levels are just coming back to where they were, and that's a good thing. The market does need to cool off. We've seen some 22 numbers, and according to what we're seeing right now, the 2022 venture capital was the second best year on record, despite the fact that, yeah, it was down substantially from 2021. And, you know, 3-year growth rates, material resources, energy, information technology, financial services, all investments at different kinds of sectors to help these sectors grow with fewer and fewer people. So the industry continues to do well, even if it's suffering from, if you will, the hangover of some of the pullback. And the tech narrative, yet again, you've seen a bunch of these negative headlines, how Google is laying off people and Amazon is laying off people and all sorts of declines in these equity values for these companies. But these are financial conversations. If you take a step back and you look at the reality is now more than ever, tech and tech investment is needed in the U.S. economy because of these endemic labor shortages. And by the way, the people who create all this, shall we say, new information, well, they're still in tremendous short supply. If you look at the information sector all by itself, the unemployment rate remains at 2.4%, one of the lowest in any particular industry, despite all those layoffs. Unemployment rate in the Bay Area remains well below 3%, despite all those layoffs. These folks are in very short supply, and if they get laid off from here, they'll get hired over there very quickly. And ultimately, when you start thinking about venture capital, you start thinking about the direction of the economy, remember yet again, venture capital is not, if you will, a purely speculative venture. It's not, like just investing in the stock market. Rather, venture capital is a way of helping the economy improve its productivity, and that is needed now more than ever. So what are we expect to see moving forward? The expansion is clearly going to continue. Wealth and income will drive consumer spending. Yes, asset values are going to continue to fall, liquidity is drying up, but underlying asset quality is going to remain strong. Think of the housing sector where, sure, cap rates for apartment buildings have to go up because of the big increase in interest rates. But the incredible demand for apartments because of the demand for housing and the lack of supply means that rents are going up at the same time. So, with underlying asset quality remaining strong, the decline in prices is just us, if you will, getting through this hangover period. There's not going to be any major overall problems for the economy. As for interest rates themselves, my guess is they'll settle down just about where they are right now, as long as the Federal Reserve takes a step back and doesn't continue to crank the rates up really pointlessly, putting a lot of pressure on the economy doesn't need to be there. Venture capital, well, again, it's an innovative market-based approach to investment in knowledge, and put aside the numbers and worries about earnings and everything else. Research and development, the growth of information, of understanding, of the basic ideas that make our economy move forward is what really matters in the industry. Are you coming up with good ideas that help businesses do more? Well, this is needed because of labor shortages more than ever. So the fundamentals of venture capital remain solid, just like the fundamentals of housing remain solid. And what it means is put aside the stock market declines and IPOs are cooling off. Underlying core profitability, finding those right companies is going to be a strong way to increase value over the course of the next couple of years, regardless what asset prices do. As for potential scenarios, well, we have to be careful about the Fed. I think they're going to sit on their hands right now, but again, they've been a little bit out of control over the last couple of years, and I'm not sure where they're going to go. We'll see. How about wild cards? Well, we do have the national and local fiscal situations. We're going to have to deal with the regulatory shakeout from the crypto debacle. But for me, the biggest worry in our world today, yet again, remains this gap between economic realities and political narratives. Remember, when these things are far apart, well, it's hard to pursue good policies. It's hard to pursue good investment. We need to work harder and harder to get these things pushed back together, because when they do, well, then we can go ahead and get this expansion off to the good start it truly deserves, not a good start that's being marred by nothing but a bunch of unnecessary headlines. So with that, I'm going to go ahead and wrap it up. Go out there, enjoy the year. It's going to be good. Avoid those weapons of mass distraction, all the crazy headlines that tell you things that just aren't true. And with that, I'm going to go ahead and sign off. Thank you so much for your time today.